What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to do some stock analysis for Morgan Stanley stock. This company is one of the largest in financial services. And as we can see here, their market share is nearly 22% as of industry revenue. And that is in the private banking services industry. Then we come over here, and these are all the financial services companies that I have ranked not by market cap or by income or revenue, but by assets. And as you can see, a lot of the ones at the top are going to be Chinese, and there's also ones from other companies. But in terms of America, so Morgan Stanley is right, where are they? Right there. So they're about what, number 20 or so. But in terms of US companies, we have Fannie Mae as the biggest, okay? JP Morgan, Bank of America, Freddie Mac, Citigroup, Wells Fargo, Goldman Sachs, and then Morgan Stanley. But they are primarily an investment services company, and they have 22% market share, so a pretty significant stock. Now, past 5 years, the stock's up 157%, market cap of $200 billion. P ratio is pretty low, pretty healthy, especially for a type of market that we're in. And they do pay a dividend of 2.8%. Okay. Then we take a look at their numbers here. Revenue is pretty strong. Last, 30 plus years has been fairly consistent. Not a whole lot of growth. They're only averaging 5% growth per year, but still it's consistent. So free cash flows vary all over the place. Net income is just not horrible, but it's just okay. I mean, obviously, from 2012, 2013 up until now, things have gotten a lot better, going from, $3 billion to 15. Now their 2023 numbers were down. It looks like they're doing $11 billion for 2024. And so that's a good thing. Cash to debt is not looking good. 267 billion in debt, 89 billion in cash. That's actually 2023. So let's see if it got better for 2024. Not by much. That's still going up. Dividends are going up. That's good. Shares outstanding is coming down. That's good. Let's go back to annual basis, and let's go to ROI of only 2%. Not looking good there. And profit margins of 17%. That's pretty good. That's pretty strong. As far as what analysts have them doing, we are looking at $7.30, which is a big jump from last year. And if we take that, divide that by, we're paying 17.3 times earnings, 17.4 times earnings. And then for next year, we're paying nearly 16 times earnings. So 16, 17 times earnings, we're looking at, as you can see, though, this is very weird. The last 5 years, the P ratio has consistently gotten higher, which is so weird. 6%, there's not really a baseline for this. Like, it's gone from 6 to 20 or 19, yeah, like a 20 now. So I don't know. I mean, I guess you could say 12 or 11 or 12 is the average, right in the middle, but I don't know. It's weird because who knows? For the next couple of years, this stock could easily trade at 14 to 18 or something like that. That would be realistic. So I would say I don't know. I wouldn't be betting that this is going to go up to 30 times earnings. I definitely wouldn't bet that, especially with them growing at 5%. So I would probably wouldn't buy over 15, to be honest. I would think about it maybe at 15. So if we're talking on a price, I mean, I would say I would say definitely under 110. I'd be interested in. I'm not going to buy this under 110. I'm saying if I really wanted to buy this stock, I definitely would wait till under 110. As far as me personally buying this, I don't know. It'd have to be it'd have to be a nice discount, like something that's obviously cheap. Like, I probably would want to pay more, like somewhere between 11 and 13. So let's say I would say under 100. If it was 90, $95, then I'd be interested in buying. That would be my perspective. So thank you very much for watching. That is my analysis for Morgan Stanley, and I will see you in the next video.